All right, welcome to another Microcap Club Business Breakdowns. Today we have KITS Eyecare joining us, and before we get started, I just want to remind all participants the purpose of this presentation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. Microcap Club is not a registered investment advisor. Microcap Club, its partners, members, subscribers, and affiliates may or may not hold positions in one or more of the securities mentioned on this program and may trade in such securities at any time. Do your own due diligence and seek counsel from a registered investment advisor before trading in any security. I want to thank the Microcap Club community for tuning into this business breakdowns conversation with Joe Thompson, COO of KITS Eyecare, and Olivia Evans, Director of Corporate Development and IR. My tag team partner for this business breakdowns is Stephen DeBear. Stephen is a private investor and writes on the Reading, Thinking, and Writing Substack. If you're interested in learning more about Stephen, we'll put a link in the show notes to his work. Stephen, thanks for joining us on the business breakdowns. Welcome.
Thanks, Adam.
The business we are breaking down today is KITS Eyecare, which is listed on the TSX under the symbol KITS, KITS, and over the counter in the US under the symbol KTYCF. KITS was first profiled in 2021 by Brian Huxdorf. KITS Eyecare is a fast-growing e-commerce retailer of glasses, contacts, and accessories. KITS offers customers access to a vast selection of contact lenses and eyeglasses, including their own exclusive KITS design products, as well as a robust suite of online vision tools. KITS technology stack, along with their industry-leading manufacturing process, removes the middleman from eye care retail and allows them to offer wide selection and low prices. Founder and CEO Roger Hardy founded Coastal Contacts in 2000 and grew the company into the world's largest online eyewear retailer, which he then sold to Essilor in 2014 for over $400 million. KITS was founded in 2019 and applies all the learnings from Coastal along with Roger's post-Coastal ventures toward becoming the premier destination for low-cost online eyewear. Management and co-founders own over 70% of shares outstanding. KITS has become the fastest growing optical company to achieve 150 million revenue run rate from a standing start and has grown at an average of 26% for the past 8 quarters, maybe 9 now. Boasts over 1 million customers and currently represents less than 1% of the optical industry total addressable market. With that summary, Joe, just want to thank you again very much for joining us today. Welcome.
Oh, thanks, Adam, and thanks, Stephen, for being here too. And we were lucky enough to participate in your leadership summit last summer in Idaho, and I've had some great conversations with folks since then. So appreciate you having us.
Sure thing. Thanks again. And I was not at the leadership summit, unfortunately, so I'm looking forward to today. And before we get into the presentation, Joe, so KITS obviously has a really interesting founding history. I think a lot of our members are familiar with that history, but if not, I'd love for you to just spend a minute or two on the history of the business. And one of the things I kind of tend to look for in management teams, just personally, and boards, is what I'd call their second act. So I know you weren't a part of Coastal, but again, maybe if you could just spend a minute or two on the inception of KITS and then what led you to the business, that would be great.
Yeah, sure. I was at Amazon.com down in Seattle, and we were really looking. There's only a handful of categories that haven't seen their online movement or their haven't had their mobile moment or their Amazon moment. So we were pretty intrigued at identifying what those categories were, and I was pretty intrigued at optical. Here's this big category that's like it's so broken it doesn't make any sense. Like 7 out of 10 people, adults, need glasses or contact lenses, and yet everyone seems to not understand why they cost so much money. And in the process, I gotten to know Roger and the business that he had built with Coastal and sold, and I just think we had a view that if that business hadn't been sold, and it was a great exit for everyone. Company raised about 40 million, sold for 450. Everyone did well on that deal. But my view and our view was that business hadn't sold and kept growing. This would be a $2, $3, $5 billion company right now. And there was just still so much work to be done. So him and I set out. We took about 6 months to build the business plan. because we didn't want to kind of rush into something. You really need a lot of capital. You need to be thoughtful about it. You can't be small in this category. This is not a category where you could be, 10, 20, 50 million. And so we just sat down, it took about 6 months and built out the plan to go from 0 to 200 million as quickly as we could and to stay profitable while we did. And yeah, it's been a great run. I was listening to your intro and realizing we got to update your some of your numbers. We're going a little bit faster than that now, so that's exciting.
Excellent. We'll look forward to getting into all that, and I appreciate that background. With that, I will turn it over to you, the presentation, to go through your presentation. As a reminder to the listeners, feel free to post your questions in the Q&A box by clicking at on the bottom of the screen. And Joe, the floor is yours.
That's great. Thanks, Adam. Now let's pull up the presentation here. We'll go into it. Okay, well, so we started KITS just over 6 years ago now, and we did it with a mission to make eye care easy. And this category is so big and so important to so many people, but there's so many steps and there's so many middle layers in the model. And so from this mission, from this statement, that really powers every decision we make, and all of our metrics really flow out of this, making eye care easy for customers. What does it mean specifically? Well, the category is big and important to fix. It's about $70 billion in the US and Canada, glasses and contact lenses. And over 7 out of 10 of us as adults require it just to get through the day. So we set out with the hypothesis that we could take 90% of the cost out of the system of making high quality prescription glasses, 90% of the waste. There's so much waste in that category, and pass that all on to customers. And so, if a pair of prescription glasses in the US on average last year cost $350, our price point is $38 to $48 for a pair of prescription glasses, including the prescription lens. And then the benefit of online is that we could build more selection and 10x the selection for customers, and give them more convenience, as opposed to 2 trips or 3 trips to the glasses store and waiting 2 weeks. We could make your glasses the same day they're ordered and deliver them to your house within a day or two anywhere in North America. And really, the mission is to deliver a spectacular, never seen before net promoter score in this category. This category is almost like the taxi industry with the NPS that currently exists, and so we're setting the goal to deliver 80 to 85% net promoter score on all of our businesses in our 2 countries every day. We've got an unfair advantage as we build KITS, and that's that the category seems to be moving to us, or building towards us as we build the company. And it's driven by the millennial consumer. So this last year, millennials became the biggest demographic in the US in every category, including optical. Millennials are now about 80 million consumers in the US and Canada. And they're this year 28 to 43 years old. And that is just prime optical age. Now, the benefit of this millennial consumer is they have the benefit and the drawback, I guess you could say, is they have incredibly high standards. They want convenience at their fingertips on their mobile device. They want to press a button, order something, and get it in 2 days or less, just like they can at Amazon. And if anything isn't perfect, they want you to make it right. This millennial consumer has, is not interested in the status quo just because either their parents or someone else they know has gone to, be it a lens crafters or something equivalent. They have no interest in getting in their car or Uber and going to one of these locations, waiting 2 weeks, paying hundreds of dollars for a limited selection. And so it's a high bar, but if you can meet it, oh my gosh, this is going to be the category for the next 10, 15, 20 years, with Gen Z right behind them. And so maybe just kind of jump into the results that we've seen over the last, it's been 6 years since we started the company. We did an IPO in early 2021 on the Toronto Stock Exchange and used that proceeds to launch our glasses business. We started the business with contact lenses and built up a block of vision corrected customers and a profit core of vision corrected customers, and then use that profit to launch into glasses and use some of the use of proceeds from the IPO to build out the next evolution of our lab. And once that lab was done, growth and leverage really started to take off. So we've just now, I posted our Q4 results and our fiscal year 2024 results to the market last week. And we just closed our 9th consecutive quarter at about 35% organic growth, and a 5-year CAGR of 35% growth as well. All of that organic. The category is growing about 3% over those years. And so we're growing about 10 times the rate of the category. And not just on the revenue side, but also on the EBITDA side as well. We're seeing a steady expansion. And so as we look across the total fiscal year snapshot of 2024, we did about 160 million in revenue. We've guided Q1 to continue on that momentum at around, we estimate in and around 35% organic growth in Q1. So that would be 10 straight quarters of over 30% organic growth. And we're seeing just kind of a steady build on adjusted EBITDA. So every one of those 9 and soon to be 10 quarters has positive adjusted EBITDA. And in Q4, that number grew to 6.5%. And over all of 2024, adjusted EBITDA was about 4%, just over 6 million. And then, maybe 2 other things to mention on the balance sheet. We're really working to deliver results up and down the financial statements. And so that includes cash flow from operations. We want to constantly be funding our own growth, and in 2024 delivered 13 million cash flow from operations to power and invest back into some of that growth. And a lot of this is helped by a category like Optical, where once you deliver a great product experience for customers, they'll come back. And once you need vision correction, you need it for decades, often a lifetime. And so if you take great care of customers, the lifetime value profile looks tremendous. And last year, even across 2024, even as we grew 32% in revenue, we still had 63% of our total revenue come from repeat customers. This category is almost like software-like with its annuity stream, if you can deliver for customers. And so that's the business. It took us 6 years to get there. We set the target, we got to go from 0 to 200 million very quickly. We think we'll do it in under 7 years from a run rate standpoint. Easy, right? Pick a category that hasn't been disrupted, put some automation in, and then watch it grow. Well, there's a reason that so few companies have really been able to disrupt this category. It's so complex, and it requires expertise. It requires a lot of capital. And it's a design company. You're designing glasses. It's a manufacturing company, a big manufacturing company. It's a fulfillment company. It's a marketing company, and you're building quite a bit of technology. So there's a lot of component pieces to it. And so what are we focused on at KITS? Well, we're focused on 3 things. The first is the foundation. So while the category has for hundreds of years now built the central nervous system around a store network and proximity to customers at a retail level, we've said, our central nervous system will be our infrastructure, our vertically integrated onshore infrastructure. And that is an optical lab that's automated and at scale, can deliver 500 million in revenue or above with the CapEx that we've already deployed. And it's not just the conveyors and the HVAC and the massive machines that edge and surface and coat the lens, and do it very quickly at scale in an automated way. It's also the data infrastructure that we built and the data warehouse where we're ingesting over 10 million unique data points every day and using those data points to improve the customer experience, improve the delivery experience, get more efficient, identify bottlenecks. And then the technology infrastructure that on the, there's about 3 layers of technology that we've built where once you press a button on KITS.com or KITS.ca, that job is at the lab in under 10 minutes, and it's often complete in under 2 hours waiting for the courier to pick up. And technology powers a lot of that. And of course, the team and the expertise to build this lab, to build this complexity, because category expertise really matters in optical. And there's ways to go around it, but it's very expensive. You have to raise enormous amounts of venture capital or debt and learn as you go. And so we've really skipped that phase. So foundation is our first kind of core building block. And then from that foundation, we look to growth and we look to marketing. And the way we approach marketing is a bit unique. My view, is that the best invention and the best creativity comes from scarcity. So we set very aggressive growth targets for our team, 25, 30% consistently, but we cap marketing as a percentage of revenue to be under sub 15% as we grow. And you've seen that in the historical quarters and years. And that really forces some invention. If we don't have, unlimited cash to deploy to, various channels, we have to be creative. And so the team has really gone to what is a cost of goods sold advantage that we have on the business, and deployed that into the marketing channel. And so this has come forward with initiatives like get your first pair free, which will run on average or will run connected with certain influencers. And the way it works is if you've never made a purchase on KITS.com or KITS.ca, an influencer will offer to their followers the chance to get a pair of prescription glasses absolutely free. And the response is always the same on this which is, well, wait a minute, nothing's free. There must be some catch. What am I missing? And they go online and there's all kinds of chat but hundreds and hundreds of thousands of customers have taken us up on this, and they order a pair of glasses for free and they hit go, and then they largely forget about it. And for them, it's like, okay, well, this is a free pair. Let me just see what happens. Let me wait 2-3 months. I'm sure something will show up to my doorstep from somewhere across the world. We'll see about the quality. Didn't cost me anything. On I go. Well, then we get to work. Then the order rolls off the printer. It's manufactured in an hour or two, and it's typically flying east that evening to get to the customer's door the next day. And so the customer then opens their door and says, well, wait a minute, how is this possible? And they're writing to us or calling us in some instances saying, I don't get it. Glasses cost me $300 to $400. They take 2 weeks to be done and 3 trips to the glasses store. You guys gave them to me for free, and you delivered them to me the next day, and I love them. The prescription's perfect. I love the look of them. What's the catch? And we just say to them, our team says the catch is tell everyone because our cost of goods sold on that pair of prescription glasses is sub $20. And the cost to acquire a customer on a traditional channel, Facebook, Instagram, or the like, is typically $100 to $200. So we'll take the risk and we'll offer customers that cost of goods sold of $20. And we'll say, we'll make the first move because we're so convinced that you're going to be blown away by the KITS experience and become a customer for life that we'll give you your first pair free. And from promotions like this, we've evolved into a model where every customer is an influencer in our mind. And so when these customers have a great experience, the first thing we do is send them 2, 3, 5 referral codes so they can pass the word on to others. And we've seen influencers start to take off as well as channel. And that approach and that mentality just kind of spiraled. And what we saw with influencers is, while they had followers across the country or across the region, their most loyal followers tended to be in the area, in the city that they were from. And so there was a moment we had an influencer in Los Angeles. She posted something on TikTok, and we saw record volume that day, that week, that month, just off of this video. And it was just a surge of orders within one city. And so the team went back and said, okay, we're starting a movement here. Let's lean into this. And they launched another program called Own This Town, where instead of blanketing marketing across the entire country, we will just focus on one city. And we'll put surge advertising in that city for 2 up to 3 months, and we'll be unmissable. Awareness will spike, trial will grow significantly, and then we'll measure. Every city's a little bit different. Sometimes you can use the metro, wherever the millennial Gen Z customer is going to be, and then we'll pull back after that 3 months from surge advertising to sustain levels, and evaluate. Okay, this tactic worked. This one didn't work as well. Let's tweak it. And then the team goes on to the next town. And then the retention team comes in to catch all those customers and ensure they come back for a second and a third purchase. And so we've only done this in a couple of towns or cities so far, but the results have been significant. And so we've identified up to 20 markets across North America. We've got a bit of an unfair advantage here because across North America, we have almost 1 million active vision corrected customers with KITS. And so we, as opposed to having to market to where we have brick and mortar stores set up, we can go to where the customers are, and specifically where our customers are. And so we might go into a town, say Chicago, and already have 30, 40, 50,000 active customers in that town that are buying contact lenses typically from us. And now we can activate those customers to buy prescription glasses and really get going in the town. So, we're not the first to create a model like this. Big companies like Uber and DoorDash have done this market by market, town by town rollout, but we've seen really impressive results. And in our view, the biggest watch out for consumer companies as they grow and as they scale is typically marketing gets more and more expensive as a percentage of revenue. And so we're pretty committed to not have that happen at KITS, and you've seen that in our results. But it is worth it to invest in these new customers, because as these customers come back, they're very profitable. And so, last year again, and the year before, and every year, over 60% of the revenue that we see comes from repeat customers. And we're investing in that retention through direct partnerships with insurance providers, where we'll do an API connection right in. So you can come on KITS.com or KITS.ca, and with some of our initial insurance partnerships, you can see right away, I've got $400 to spend. It expires the end of December. And then you can apply it in some cases right in the checkout, so you have no out of pocket. We have an auto ship program for contact lenses, and a KITS Plus membership program, and more to come. So first is the infrastructure, the central nervous system, which is our onshore vertically integrated manufacturing and technology. Second is our unique approach to marketing. And third is our approach to shareholder value. And we feel that as we grow, shareholders should benefit as much as customers. And if you talked to us 6 years ago when we started the company, or a year ago when we were together in Idaho, or 5 years from now, it'll be the same approach. It's really focus as much as possible on organic growth to be the primary driver. These last 9-10 quarters have been a great example of that. 30-35% growth organically. The second, and a key one for us, is do the hard work first. Because if you do the hard work first, and then you can grow into to the favorability, And not only customers benefit, but shareholders will really benefit from those results. And so examples of this include, starting with contact lenses, a smaller part of the category, but highly profitable and vision corrected. Another example is, building an optical lab before we sold a single pair of prescription glasses, so that and putting our own capital at the time into that lab, so that we could maintain the high bar that we want to set for customers on quality, and also capture the cost savings and pass those on to customers, and building capacity to 500 million that we can now grow into. Another example is going public early on the Toronto Stock Exchange and really getting in the cadence. It's not easy in the first year. It wasn't for me, that's for sure. Of the first couple quarters, and really building the organizational muscle to be a public company, and to generate forecasts, to generate meet and beat expectations, and then to invest in long-term growth channels like the customer. The customer is the best growth channel. Our view, the Facebooks, the TikToks, those channels will change and evolve over time, but the customer, is always going to be there for you. And last, be really thoughtful about dilution. We've done exactly one equity raise since we started the company. It was the IPO in 2021. Helping along is results, and you can judge us by our words, but we'd prefer to just judge us by what we've done in the past, and then judge us on how well we execute on what we say we're going to do in the next quarter, in the next year, in the next 2 years, and steady growth on revenue, adjusted EBITDA, but then also working capital. Growth is great, but growth can also eat all your cash in terms of marketing spend, CapEx deployment, and inventory. And so we keep a real tight watch on this. And we've seen, we had a debt facility with the Business Development Bank of Canada, and we've just been gradually paying that down. It's now as of the last couple of weeks, it's sub $4 million. And we'll take that facility out entirely in the next 3 to 4 quarters, while we've been holding cash consistently, pushing and using data to increase inventory turns and increase inventory efficiency. Really put a limit on CapEx. We were about 1.5% of revenue CapEx in 2024. We want to be the same or lower this year. And then we talked about the cap that we put on marketing. It's working capital is not as celebrated a metric, but for us, it's very important to maintain control and to fund our own growth as we go. Across the business lines, from fulfillment, G&A, and marketing, our goal is to just get more leverage on the model as we grow. And marketing was the one exception. Last quarter went up a little bit, tends to go up a bit in Q4 as some rates come up, and especially during an election year. But our view is that's returning to historical levels of previous quarters this quarter. And our fulfillment, our operation should be getting more efficient, as we put more volume into it, and it is, and same with remaining G&A. And we're happy to have strong sell side coverage. We have 7 covering analysts now, and last week, as we announced our earnings, 3 of them, another 3 took up the target price, which is now kind of a mix of kind of $14.50 to $18 as a target price for the next 12 months. And we try to keep the capital structure simple. 20 million cash on hand, just under 4 million in debt, 31.5 million common shares. That's it. We talked about last and certainly not least is the category expertise that's needed in e-commerce and an optical. Really having, there's a pathway for sure to kind of come out of school and jump right into an e-commerce venture, and there's many examples where that's worked. It's almost always required a significant amount of venture capital and a significant amount of debt, and so we're proud of our gray hair, and we're proud of the experience we've had, and we think the team that we built knows optical, knows technology, and knows e-commerce. And so we're excited to keep this momentum going. And thanks again, Adam, for allowing us to share the KITS story.
Thank you very much. That was great. Really comprehensive and very impressive what you guys have accomplished so far. So we can start the Q&A session. And as a reminder, if you have a question, feel free to enter it into the box at the bottom of the screen. And I'll kick off the question set by just asking. So I'd love to maybe just kind of start higher level here. I don't think you can achieve the run rate revenue profile that you've achieved at the pace you've achieved it without a combination of a lot of things: hustle, determination, a vision, thinking differently, your culture, etc. Can you just maybe talk about kind of what's going on inside the business from a culture standpoint and kind of what you're all incentivized to do and what you're all driving toward?
Sure. Yeah, we're all at the core, we're all owners. So we have a huge percentage of our company that participates every month or every pay in the employee stock ownership plan. And then the company, we match that. Any investment an employee makes, we'll match it. And so we're for the most part, we're all owners of the business. And so that's important. It helps that we're in this category as well, because you see the difference that this category makes. And so intellectually there's a strong rationale to go into the category, but then emotionally, we ran a study, and this was a Canadian study, and we got another one going in the US shortly, but we found that 1 out of 2 Canadians delayed the purchase of a pair of prescription glasses because they couldn't afford it last year. I mean, that is just bonkers. You need a pair of prescription glasses to see, the chalkboard at a school, or to see the screen in a boardroom, and you're, squinting and delaying that purchase because they cost too much. And so there's millions and millions of customers, tens of millions of customers that we're going to be able to improve the lives of, and really kind of open up this category for the first time for them. So I think that's a mission that that a lot of folks are pretty inspired by. And then the best culture is made by setting and achieving targets. And so so we have 5 rocks that we set every quarter, and march towards them and celebrate when we hit them. And this is not just a bunch of technical folks coding a website. We're making widgets here. We're making glasses. And so we set targets up and down using data to get better every week, every quarter. And the directive to get better doesn't come from us. It comes from the team. And we have all kinds of examples of where we'll say, could we get another 100 orders out shipped same day versus what we have, and how would we do that? And we don't know the answer, but we had an example in the lab a couple of weeks ago where one of the line leaders running a number of the machines had said, if we reorganize our break schedule and just stagger it a little bit, we're going to get another turn of the machine before the carrier cutoff, and that will allow another 75 to 100 orders to be shipped same day. And sure, that's a very small invention, but the combination of 50, 100, 500 of those across different parts of the business just increases the moat and increases our performance. And that's another 100 customers each day. They're more likely to come back for a second purchase because they got their order the next day. And maybe the last thing I'd say is, there was a lot of, we started this company really as we were going into the pandemic. And so we really scaled the company, took the company public over Zoom 3 days before Christmas in the pandemic. And so, the resiliency of a team that's kind of gone through building a company during a pandemic, going through the supply chain crunch of, a year or two ago, and then, postal strike in Canada and all kinds of other, things, has just really built a resilient organization, all proud to and excited to come to work with each other every day.
Excellent. Yeah, thank you very much for that answer. I think Kits seems like a business that tries things, and that's one of the hallmarks of a great business, I think. When you experiment and you invent and you innovate, and you've talked a lot about innovation and presentations you've given, and in terms of trying things, I think Amazon is probably the best example of a business that has done that historically, and that's obviously in your bio. But one of the other things that they are so good at is just delighting the customer, and you see that seems to be a big focus of yours. You number one, talk about it a lot, but also put your money where your mouth is. And you've done, I'm a customer, in full disclosure. I don't have my glasses on now, but I had a great experience and I know others have done the same, have had the same. So I'm curious if you can just talk about, again, more cultural type of thing. Where does that mentality come from? Is it a top down thing? Do you hire for it? Is it a core value? Can you just talk a little bit about your kind of desire to just do right by your customers and, have allow them to have a great experience?
Yeah, we love that, consumers are just, as the saying goes, divinely discontent. And I think as a company, you can really organize around explaining why you're doing something a certain way, or you could organize around just improving the performance. And so, examples of this include, like, we see examples where, someone says, okay, it's going to take a week and a half to ship something to you. Um, and so what we'll do is we'll build technology that sends you a little notice every 2 or 3 days, on how your product is coming along. And for us, that probably improves a not great customer experience a little bit, but we'd rather focus on just getting it to you the next day. So take that investment and just point it towards um, just improving the experience. Sure, we could say to customers, well, it's not the same as a t-shirt that you order on Amazon, because we're ingesting your prescription. We are manufacturing your glasses made to order with your prescription. You're surfacing, coating that product and getting to you, and then mailing it to you. And so as a result, it should take us longer than the t-shirt that comes from the fulfillment center at Amazon. But that, for us, that's just a waste of energy. Let's set the bar high, and let's see, if we can get every pair of prescription glasses to a customer anywhere in North America in 2 days. Well, we know that is something that is going to make a material difference for millions of customers. So let's put the energy and the effort there. So I think, having that organization around that has probably started from day one, and we've definitely built the team around that. I think having a North Star of Net Promoter Score is just a wonderful thing for any organization. And then we have an employee Net Promoter Score as well, so we can read the data on both. And it's hard to hide from the Net Promoter Score metric. You see promoters, you see passives, and you see detractors. And so we've done certain things where we've created a Slack channel. We now post that Slack channel in the lab, which is a live feed of the actual NPS results that we're getting from every customer as we receive them. And so, if you're working on assembling a pair of glasses, or are monitoring a machine, and you're watching a customer come by, oh, my order was delayed, I'm a detractor. Hey, something didn't go right, I was a detractor. Now there's no dissemination of data, you're just seeing it. And everybody in our company is looking at that NPS channel every day, doesn't matter what they're working on. And so I think there's little things you can do, but really it's just having the organization around and the focus around Net Promoter Score, and then just kind of celebrating wins in that.
Excellent. Thank you. Yeah, I think it's certainly what you mentioned certainly seems like it's bleeding into the rest of the organization from an innovation perspective, and also just thinking about things differently. So I'll ask maybe one more and then pass it to Stephen. So your approach to marketing has been really interesting to watch, and I'd love to learn a little bit more about it. And so I'd imagine there's been some kind of pressure, maybe not internally, but from somewhere, to grow faster, or to plow more money into marketing and sort of step on the gas in that regard. But you've obviously chosen to take a different approach, and you've grown with limited investment. You've gotten very creative about it. I love the idea of these marketing blitzes in small regional clusters. Um, and I'd love to just hear you talk a little bit more about that. Again, how you think differently there, why not ratchet up the spends? You mentioned it a little bit during the presentation. Why it's important for you guys to grow profitably, that sort of thing would be great to just get some color on.
I think it starts by just being good students of the market. And talking to a lot of folks, and I've talked to a number of folks that have built big businesses, billion-dollar plus businesses, and many others who've partnered with them on the way. And then the feedback we hear is, okay, where do companies go astray on this journey? And typically, especially on the consumer side, growth becomes more difficult as you get bigger and a lot more expensive, and specifically on the marketing side. And so the temptations are definitely are well documented. It's excess spend on marketing, and it's really making CapEx decisions that are short-term driven, like opening up a whole bunch of stores. Stores are a great short-term metric. You have no revenue in a certain area, and you put $1 million, $2 million of CapEx into an area, and all of a sudden there's revenue where there was none before. And that feels good. And then you go and do it again, and you go and do it again. And the problem is you built a legacy infrastructure, and somebody's got to pay for that CapEx. And there's only two people that pay for these decisions typically. It's either the consumer or the shareholder, in either higher prices or in denigrating results. And so I think at the beginning we've just set out to just be really thoughtful about and just be humble students of this great market in North America, and where have the best got it right, and where have others got it wrong. And then knowing that, let's set a high bar to be one of those companies. And then maybe the other thing is you mentioned it, and I think it's important, is just really this idea of coming in and tinkering and earning the right to get to the next level. So even with influencers, we came in and immediately you have people reaching out to you. We can get this celebrity to post this for you. It's $1 million. They'll post it. They've got all these fans, and it's tempting. But for us, it was a 15-second discussion when the offer came in, where we said we haven't earned the right to do that. We don't know that this model will work at that level of scale. And we've got to earn the right to spend that money. If we ever do, we probably won't. And so we start with these micro influencers who we're not paying, just giving free product and saying, if you love it, post about it. And if you don't love it, we'll post about it anyway. I mean, then we'll get the signal. So I think it's really and then celebrating those wins as we make progress in them are just a couple of the examples.
Great. Thank you very much. I'd like to pass it on to Stephen now for some questions, and then hopefully we can take some questions from the audience as well. So Stephen, the floor is yours.
Awesome. Thanks, Adam. And Joe, great presentation. You mentioned recurring revenue being a bit like a software company, and I agree. And KITS actually passed the rule of 40, I think, in the last quarter. So congrats on that. The company has been cash flow and EBITDA positive for the last couple of years. You had 4% EBITDA in 2024 and achieved 15% EBITDA on Black Friday. You're currently reinvesting in growth, which makes sense at your current stage. But where do you see the long-term profitability margin of KITS once the company's mature and at scale?
Sure. Yeah. Thanks, Stephen. Great to see you again. And if it's okay, I'll share some internal targets. It's not formal guidance at all, but as you can imagine, we have targets for ourselves and for our team, and I'm happy to share them with that caveat. And so, for us, we think this past trailing 12, we were 160 million revenue, 4% adjusted EBITDA, and it's kind of accelerating in Q4 to 42% growth and 6.5% adjusted EBITDA. So as we think about the next 2 years and the next 5 years for our business, our internal targets are to be a $250 million revenue business within about 2 years, and to have at that level adjusted EBITDA of in around 10%, or likely a bit above at that phase. And then over 5 years' time, we feel like whether it's 4.5 or 6 years, but call it 5 years, a $500 million revenue business with adjusted EBITDA of 15 to 20%, and ideally a little bit above that. So those are our targets.
Awesome. I appreciate the transparency. So the pushback I hear the most is, how can you have a sustainable competitive advantage selling contacts and glasses? On the other hand, after following your results for the last few years, it's clear to me something special is going on here. We're seeing significant and predictable organic revenue growth, as you mentioned, industry-leading customer retention and net promoter scores. So my question is this: you have a clear cost advantage over brick-and-mortar eyeglass stores and a shipping speed advantage over companies that manufacture offshore. But what is your advantage over other online eyewear retailers that also manufacture onshore, like KITS? Maybe Zenni Optical would be an example.
Yeah, it's a great question, and I think we have a number of a couple online only competitors, and we think they're by and large doing a very good job. We're in kind of a unique spot where, as the market moves online, I would actually like to have one or two additional pure online competitors, because it would help. It wouldn't just be up to 3 or 4 of us to move this whole category online. We could share the investment, and none of us are going to run out of market share as this big $70 billion category. 1% or 2% every year moves from traditional hyper fragmented mom and pop optical shops to online. So we think they do a great job, and we're cheering for them, and we would benefit from another 1 or 2 like-minded competitors in pure play online. The organization of being pure play online is important, because as we think about this category, for hundreds of years now, it's been really organized around brick and mortar, the whole brick and mortar infrastructure. And we'll have folks say to us, well, I don't get it. What's the moat? You just build a lab and, start shipping product and have a website, and there you go. I mean, this can't be that difficult. And I kind of think back to a moment when I was at Amazon a number of years ago, and we'd have folks from another big, retailer in the US came into one of our fulfillment centers, and they looked around. You can almost just see the relief in their eyes, where they said, that's it. It's just conveyors and shelves and a website. We can do this too. Well, it turns out that, and of course, we're looking at our business and our business results and saying, it's already over. You've already lost. Because it's very unlikely that you could take an infrastructure where 100% of the revenue and profit is in one system, which is running stores, staffing stores, ordering product from distributors or sub-distributors, outsourcing to a third-party lab, and then completely reorganize that around a digital footprint. And then on top of that, having the data signal that we get, 10 million unique data points that our team's using. Hey, here's where the customer got stuck in the process. We need to improve this flow immediately. Or, when this product was manufactured in this way, defects went up by, X basis points. Let's get a team on fixing that. Or shipments to this one city seem to be a problem with this one carrier. We need to correct this, and seeing that data in real time. And so really, the moat is the lab, and it would take 3 to 5 years to recreate our lab and tens of billions of dollars, but that's not the moat. There's the technology that allows you to, press a button and have the machine already know after you order on the website that order's coming. And then once the scan comes in, to precision cut it perfectly. That's part of the moat, but really it's the daily tweaks that we're making on the business that are extending that moat and extending the value delta day in and day out, as we put from 1,000 jobs a day to 2,000 jobs a day to 5,000 jobs a day. And the leverage that you get and the efficiency and expertise that you get, that's what has us excited. And as we think about being a 500 million revenue business, and the leverage that we'll have on that operation, it will be significant. And I guess, last and certainly not least, people tend to think about, well, the component pieces. If I was to replace this machine or this person or this, underneath it all, we've built up a active, loyal base of, almost 1 million vision corrected customers that are repeating every year at 60%, over 60% of our revenue. And to recreate that base of active vision corrected customers that are repeating, I mean, it would take any company at least 10 years and hundreds of millions of dollars to do. So I guess that's maybe how we think about, sure, we're faster and we're going to get faster. Sure, we're cheaper and we are going to get cheaper. But it's not just those two items. It's really the infrastructure, similar to other companies that that have seen breakout sales like Amazon and others once they've gotten to a certain level. It's the whole infrastructure that allows you to be constantly improving that we would consider our moat.
Great. Appreciate that. So as a capital light business, what will you do with the cash flow generated from KITS in the future? We saw a buyback recently, but could you also touch on what you think of potential M&A in the future?
Sure. Yeah, we see lots of opportunities. First, with M&A, we have a list of kind of 4 critical metrics that any M&A would have to deliver on, and we've not found one that has met those criteria. And we'll be very strict on that because M&A can be distracting and it can draw attention away from your current business. That's not to say we won't eventually. That could be something that, if we could buy a business that's a creative, where we acquire a block of vision corrected customers cheaper than we could in the market, where we had confidence that we could expand the basket size and see significant adjusted EBITDA improvements, taking a majority of G&A to the bottom line. We have not found it, but the chances are we will come across one of those instances. But really, we start that conversation by saying, what's a better investment, us or this other business? And up until now, it's been overwhelmingly, let's put it back in our business. And 35% growth, generating 13 million cash flow from operations, and 4% adjusted EBITDA over the year. If we keep going, that will always, we think, be the case. So that, but how will we deploy capital back in? Well, we're going to expand selection even further. You can't have enough selection in this category and continue to invest in high quality glasses. We could cut costs on frames, especially at the scale we're at. But for us to have a perfect pair, I made this pair in our lab the other day. Perfect hinges that over time, don't kind of flop down and get loose. The prescription lens that is perfect, and then more investment into Own This Town, rollout, and hopefully continuing to see that execution come through, and then expanding the cities. Eventually, we want to build the confidence and earn the right to do 2 cities concurrently, and then maybe 3 cities concurrently. But we'll be patient and move slowly on that. On share buybacks, absolutely. If we see, we had an opportunity a couple of years ago to do share buybacks, and we didn't take advantage of it. And that, as the stock was at $3 at that point. What a mistake! And we won't make that mistake again. If there's an opportunity and where we see the stock, below a certain threshold, we'll take action, certainly.
Appreciate that. Adam, do you want me to keep going, or do you want to go to the audience?
Yeah, feel free to keep going. I can jump in whenever you're finished, or feel free to keep going.
Okay. So Joe, I think it was you that mentioned on a recent quarterly call, the last one, that you're seeing good demand, not just online, but also in store. How many storefronts and pop-ups do you currently have? And do you think Kits would invest into in-person storefronts in a meaningful way in the future? And if you did, would you need to raise prices because storefronts come with more overhead and are less scalable?
Yeah, we have one store, and we love it. It's in Vancouver. It's right on Kits Beach, Kitsilano Beach, which is kind of the heartbeat of Vancouver. Um, and it is really a showroom for us. It used to be a Starbucks, and it's where Raj and I went in the early days. We were building the business plan. Unbelievably, Starbucks decided to move out of that location, and we said, okay, it's too good to be true. A brand name Kits on Kits Beach, right where it all began. We're doing it, and so but you don't want to do it in the same way that others have, and so um, we opened it's a coffee shop. We serve coffee, we serve food. It's a meeting place. We also have an optometrist in the store, and we sell about 10 times the number of prescription glasses in that store than the average optical store sells in North America. Um, but it's a pretty unique setup, and it's really, as you said, it's a marketing exercise and a marketing spend is how we look at it. So we have one. It's performing spectacularly well. Would we have others? We'd probably have a couple showrooms across maybe two or three in Canada, four or five total in the US. Maybe not even that many over the arc of time, because as you said, someone's got to pay for that capex, and you really want to be sure before you invest. And it would really just be a marketing investment in exposure and in a showroom and really a meeting place to celebrate the brand. But the whole infrastructure will continue to be digital and vertically integrated, certainly.
Awesome. So the question on tariffs, there's a lot of noise surrounding tariffs. 68% of Kits revenue was from the US in 2024, and you manufacture your glasses in Canada. Can you go into your thoughts on tariffs and if they were to come in effect, how that might affect Kits revenue?
Sure. Yeah, no, we're actively watching. I don't think I've ever refreshed my browser more times on my news site than I have in the last month. And who knows? I haven't checked this morning, so whatever I say might be out of date. Uh, but here's how we think about it. We have two businesses in two countries, contact lenses and glasses in Canada and the US. And our contact lens products are none of them are manufactured in any of the countries that I've identified for tariffs. In fact, most of them are manufactured in the US, and so we see little disruption currently on the contact lens side. On the glasses side, certainly no disruption in the Canadian market. That'll probably be favorable if there is a change. But in the U.S. side, I'll maybe explain the way that it's currently viewed for country of origin, and then if that changes, how we plan to address it in a worst case scenario. How it's currently viewed is the country of origin is the source of the raw material lens puck, and so none of the countries we source from. It's a lot of Europe. There's some Taiwan, Israel have been identified, and so currently that's not something that we have to think through. But of course, as you'd expect, we're planning. We see where this is going over the next 4 years, and there'll certainly be an advantage to made in the U.S. And so here's how we're thinking about dealing with it. We have the ability with the infrastructure that we built to set up a micro lab. And the way we'll likely do it is we'll take a couple of the machines that you've seen in our lab, and we'll just some of the big industrial edgers, and we'll just relocate those into likely Washington State and inject into Seattle. And we have plans to do this in the out years anyway, and just really set up a bit of a micro lab infrastructure. We've got the big lab and then a micro lab maybe on the West Coast, and eventually maybe even one on the East Coast. As our revenue expands, it'll leverage the same infrastructure. We think that that's something that we could do, and our team has done before with the previous company, in really in weeks. Worst case, a month or two, and no impact to capex as a percentage of revenue. And so for us, we're really excited about the opportunity once whatever's clarified, whatever the rules are. We're really excited to quickly get to a steady state. We have a small, nimble team and infrastructure, and do that in sub 1 quarter, ideally 1 to 2 months, and then hit the gas pedal. I was reading a report from the Vision Council last week in the US that 73% of all the prescription glasses sold in the US last year were manufactured in China, across the country. And so this whole industry is now thinking about, oh gosh, and most of the industry is big companies. And they're thinking about, well, how do I reorganize supply chains? How do I, reorganize staff and financial metrics, and we don't want to be burdened by that. We just want to quickly get to the steady state. And then, we think the value delta for us, we don't source component pieces from distributors or sub-distributors. We design every pair of KITS glasses ourselves in our lab, and we source ourselves every single component piece, and we've got redundancies below that. So in a category that operates on layers and passing price increases through all those layers progressively to the customer, our focus is just maintaining and actually improving the cost delta that we see versus the competition. And as the saying goes, like, it's hard to pass cars on a sunny day, but on a rainy day you can pass a lot of cars. And so we're ready to get moving, and we're ready to pass a lot of cars in this environment.
Great. So you've launched a few new products and services recently: the KITS Plus membership, colored contact lenses, KITS.TO, and smart glasses. Which one are you the most excited about?
Picking amongst your favorite children. That's a tough one. I think smart glasses is really interesting as a category, and we've got high expectations for it, but it's early, and so we just want to manage expectations on that. This will be a slow burn to get to how we got excited about this category for 2 reasons. We were talking to the folks at Meta, and what they said to us was, they had seen on smartwatches, within 5 years of the day Apple announced the launch of their first smartwatches as a category passed non-smartwatches as in sales, and it's never going backwards. And they thought the form factor of glasses was even more convenient, and that's why they and others are building towards it, and that made good sense to us. And then when you put on a pair of smart glasses, you really see the benefit. I can listen to a podcast, I can answer the phone, I can take a picture from my glasses, but it's going to take a little while to build. Technology is going to take a while to build, and we'll build our own KITS glasses. We had the first version we called Pangolin. It sold out quickly. We got the second one coming. It was a small base. And really, where do we think we could contribute to this category? We think we can offer the full selection. So you buy Meta smart glasses on KITS.com. Ideally buy everything available in the category. But really, and we'll have our own, but we can be the engine for prescription lenses. So if you were to go on Meta, order a pair, beautiful box will come to your door, cost $300-400. You'll take them off, put them on. Wow, I love them. Oh no, I can't see. There's no prescription in here. And so now it's a lot of work and inconvenience for you to go get that. We've now, and it's a complex assembly assignment because there's wires running through the hinges, for the cameras and the video and the audio. And so, we've really been at building up the expertise on that. And we think it'll be interesting, but I would say that's further down the road. I think to answer your question, I think extending our own brand of KITS into daily silicone hydrogel contact lenses is very interesting. giving the convenience of contact lenses to everyone at the same value that they can buy Kits glasses is probably the most interesting. And maybe right behind it is customizable glasses with the Pixas, where, which is a line that we're just building, where you can put, your own symbol, and we have jewelry brands building to us, so I think that one's just getting started.
Awesome. Yeah, I've heard some really good things about those Meta smart glasses. I might have to try a pair. So last question for me. I saw a 2024 study from the Vision Council that said 15% of prescription glasses are sold online versus in-store, and 37% of contacts. What do you think of these statistics? And in 10 years, do you think the percentage sold online will be much higher, and why?
Yeah, the data that we've seen on online is encouraging. We've seen the data that we've seen is around the beginning of the pandemic, glasses as a percentage of total optical was in and around 6 or 7%, and it's now around 20% from the data that we've seen. Although the intent is much higher, around 50. And on contact lenses, it used to be 15, 16%, and it's now around 40%. And so yeah, we think both the prescription glass category in particular is really going to march towards this 30% penetration of online, and then once it passes that, our view is what we've seen in other categories is it then just becomes it's like every other category that folks said, I don't know if this will work online, and then it does, and then all of a sudden people say, well, okay, that's just that's how I'm going to do it. And it's really powered by this millennial cohort, which just has told us again and again, we really want to order everything online, and we want to shop and browse online. And we're seeing that in the data kind of, and we didn't get into too much detail on this on the earnings call last week, but revenue growing 42% was great in Q4. But what we're even more excited about was traffic was up about 80% in terms of sessions. And so that means a lot of exploration is happening. And so even if some of those customers are exploring and then not quite ready to make the purchase online, progressively, if we continue to execute, progressively that number is going to increase and bring more online.
Awesome. Thanks, Joe. Appreciate your time.
That was great. Thanks, Stephen. Great questions, and thanks for all the color on that. If we're okay on time, Joe, we can just ask 2-3 questions from the audience and then wrap up from there. Is that all right?
Sure.
Excellent. So yeah, a couple questions on just going back to marketing for a second. As you think about the influencer strategy, can you disclose any information, maybe not specifics of names, but just around kind of your most productive influencer sets, and maybe how much revenue is associated with them? And then I'm curious, as a follow-up to that, if these are paid promotions, and if rates are going up. Obviously this is the channel kind of everyone's leaning into. I'm curious if there's been a change since you started this strategy until today. Just some color on that would be great. Thanks.
Sure. Yeah. Maybe I'll just kind of talk a little bit generally about what we're seeing there. We don't break out too much detail. And we can share after the fact examples of some of the influencers that we've seen that have really created a significant lift. We had another one last week, 2 weeks ago, sorry, where it was an unpaid influencer that we compensated her with free prescription glasses, and then she posted, and it was it was very successful. So overall, what we're seeing is it's now our biggest acquisition channel is influencers / word of mouth by a significant margin, and it's also the cheapest from a CAC standpoint. And that makes sense with the way that we approach influencers. So, as opposed to kind of going to the top most expensive, we're really focused. Our team, I should say, is focused on identifying folks with followers anywhere from 10,000 to 200,000 or 300,000, and and really that sweet spot of this influencer that earns their followers by offering great suggestions and great products. And as a result, we're seeing the engagement per influencer with that cohort of influencer really be spectacular for us. And and where we've had experience in some bigger influencers, you tend to see just a different dynamic. The micro influencers are just so powerful in the area that they live in their city and their state. Um, and they're very open to partnership opportunities. So it's probably an area we started late on. I think I personally I was skeptical on it. As it started, I thought influencers that had already been done and seen, and so I was hesitant to invest more money into it. And we kind of got there by tinkering and trial, and where we saw the biggest when we would run a first pair free promotion, the best promoters of that first pair free were the influencers, and we ended up just organically kind of building a base of and a following of influencers, and then eventually built out a team to turn that into a channel, and now it's our biggest one.
That's great. Thank you. And then on the site itself, so it looks like you're currently running some promotions. I'm curious if you can just talk about the role that those play within your overall strategy. And then also, I think there's a stated shipping time between 7 to 10 days, unless I'm mistaken, but obviously you're a lot faster than that. Is that sort of an under promise, over deliver type of thing, or how should we sort of think about that? Unless that is the timeline for some products. Thank you.
No, that's right. It's an under promise over deliver, and it's different by area and by product, and that's another area where we're just going to get technology and data just allows us to be, and scale just allows us to be better and better at that. So right now we are making and shipping I believe it's over 95% of all single vision prescription glasses the same day that they're ordered. And so now it's just an exercise of how fast we can get them to your door from the lab. And what we've seen is, the faster that we can do that, the higher the net promoter score is, and the more likely that customer is to come back. Because there's just it's a cognitive load that you have in your mind. I've ordered something. When was it going to come? Is it 2 days? Is it 3 days? Is it 5 days? You're just thinking about it. You're just aware of, do I need to look for that? And so the second it arrives, you're lifted of that responsibility. And so so we're focused on delivering every product in 2 days or less. We're not doing that 100% of orders, and that's that's something we're very much focused on. Each promotion's a bit different, and the benefit of a digital infrastructure is you can really have different promotions in different regions consistently. But offering especially first time customers a great offer. They're taking a risk to try kits, and we respect that. And so as much as possible, we'll take our cost of goods sold advantage and we'll use that as opposed to, investing in, properties like Instagram or Facebook. We still do some advertising there, but it's really just, the goal is to limit that as much as possible. And I'd rather give, if this pair of glasses cost me, $17 to make in our lab, cost of goods sold, plus shipping costs. I'd rather give that to a customer or give them an initial discount to say, we'll bet on you, we'll bet on our own experience, and we'll bet that you'll come back again and again, and we'll make that investment as opposed to, really organizing teams to create and kind of quote unquote hack around a specific channel. I mean, you just kind of you see again and again, and you hear the feedback from others that are building companies where they're like, I spent all this time and we built an organization to kind of growth hack around, whether it's Instagram or TikTok or whatever the channel is of the month or of the year, and then they changed the algorithm, or they changed the approach, and I was back to square one. Or I had an advantage for, a little advantage versus the competition, but then they adjusted and they caught up. And for us, we just always want to be organized around just, as much as possible, stay out of that noise and just stay focused on building to customers and watching that net promoter score come back. And over time, we may miss a couple growth hacks and miss an opportunity to see an occasional spike, but over time, we feel like that customer that comes to us and says, I've got this, here's the delivery expectation, here's the value expectation, and if we can meet and beat that expectation, well, that's more important than tricking some algorithm on some marketing channel.
Great. Thank you very much. I will wrap it up here. So let's talk about insurance for a second. You have mentioned this in other places as well. Is it a difficult thing to get on insurance providers' plan? Can you just talk about the challenges there and maybe where you're innovating around that or hoping to be in the next couple of years?
Sure. Yeah, we started on this in the Canadian market, just kind of tinkering with some of the plans, and we developed some success. And the difficult part was really around the tech build, because we want to offer a better solution. We just don't want to be a list of names and for folks to consider. And so the best in class that we've done is with a couple big Canadian insurers where we have the API connection built in. And so you could see there's two, as we talk to customers and try to work backwards from their experience, what they've told us is there's two dissatisfiers. One, they have no idea what's covered and what's not. So they walk into a glasses store, a brick and mortar glasses store, and the frames cost $400, and the coating costs $50, and the upgrade costs $75, and they have no idea. Maybe some of it's covered, maybe all of it's covered, and maybe none of it's covered. And so it's a total leap of faith. And they hand over their credit card and cross their fingers. And then after that, they have to fill out a bunch of paperwork, and then they have to wait and get compensated for part of their purchase. And so we set out with these insurance providers to just fix the model, and the API connection into their system really allows us to do two things. You log in, here's my plan number, and it pops up, hey, Adam, you have $300-400 of vision insurance. It expires end of December. And immediately what's covered and what's not. So the customer just relaxes. And then when you get to the checkout, you can apply it right there. And so the net promoter scores on this experience are fabulous. There's no paperwork. We handle it all at the back end with the insurance provider. And so for us, that's a gold standard. The difficulty is just the tech build takes a little longer. Our team, is happy to do that in days or weeks. But insurance companies move a little bit slower, and so you have to build it, and that can take a year, can take a year and a half to do. We think it's worth it. We think the moat is substantial once you have that technology built, but that's what takes the time in our view. And so now we're turning our attention to the U.S. market, and which is a little bit more fragmented, and so there, we haven't really seen any pushback on engagement. But really, it's the work is around finding, setting a bar high for the customer experience, and then just being patient to build that technology together with them, and third parties in the U.S. market, to specifically for an online purchase, to make it a great net promoter score experience for the insurance company, for the customer, and for us. And it just takes some time. But in 2024, we made significant inroads in Canada. And we have some aggressive targets in the U.S. market for 2025. So stay tuned for more news there.
Excellent. I'm looking forward to seeing how that unfolds. Thank you for sharing. That's a great place to wrap it up. And again, thank you very much, Joe, for taking the time today to visit with us. You guys are doing excellent work, and I think have really built a better mousetrap. And it was great to get a chance to showcase you a little bit further today. So we really appreciate the time and all the color provided on the business. So thank you again.
Well, thanks to you, Adam. We think Microcap Club is at the top of the market, and we were delighted to and really in awe of the operation in Idaho last summer, and excited to be together in person with you and your team and your members in the future again. So thanks for having us.
Excellent. Yeah, and for participants, the recording, and Joe, the recording of this presentation will be available, and we'll distribute it as soon as it's out. And want to thank everybody for joining in today. So thank you again very much, Joe, Olivia, Stephen, and have a great rest of your day.